The end, after reflecting about the management, we still believe in them. We still think they are good. We still think they are honest. We've added back, and now it's again at 9% of our portfolio. So it's our largest holding now by difference, by far. And yeah, we've been back in all these weaknesses during these past months. We have to keep an eye on these things. There's going to be an improvement sooner than later, that the M&A is being done at nice multiples, that they acquire high margin businesses, that the cash flow conversion comes back. So if those things that we are going to monitor closely don't happen, I mean, we will reduce substantially, of course.
Guys, let me tell you a 30-second story, and I promise you won't regret it. So when I started to take investing seriously, I really didn't have anyone to discuss my ideas with. I knew no one in the investing space, and therefore my process felt kind of lonely and very slow as well. So I went on and found a community of serious microcap investors, people that actually like doing the work. And I'll let you in on a little secret. It's called microcapclub.com. Members have profiled more than 1,300 companies, and over 300 of those have gone on to become multi-baggers. That's the power of this group. The awesome thing is that you'll get exposed to ideas well before institutions ever notice them. And if you want to find great businesses and surround yourself with some of the best investors in the world, head to microcapclub.com and consider applying to join or becoming a subscriber. That's microcapclub.com. Nothing in this conversation is financial advice. I may hold positions in some of the companies we discussed or have other interests. I always aim to stay objective, but please take everything with a grain of salt and do your own research.
Hey, Carlos, it's great to have you on again. Our last episode was very well received by the audience. And so, yeah, and I always like to chat with you. So it's a pleasure to have you on again. My first question, and jumping right into them, is Teqnion dead, and what do people get wrong with that framing?
Yeah, David. Well, first of all, super happy to be back, and thanks for the invitation. I had a lot of fun last time. I think it was around 1 year ago. So always happy to catch up some in a while. And yeah, regarding Teqnion, because I think we discussed a little bit about Teqnion, and it's been on X. No, it's been a quite polemic name, or there are like lovers and haters, and we've been invested in Teqnion since 2021. We think we know the company quite well. Is it dead? Well, we don't think so. I mean, we think they've made some mistakes on the way. They're a small company. They're a small serial acquirer. Daniel, for the guys who don't know who he is like the co-CEO of Teqnion, together with Johan, who was one of the founders. He jumped in 2021. He's young, he's ambitious, he's great. Together they make a good team, but it's normal that during the process of building Teqnion, they've made mistakes or not a proper communication. Sometimes, David, I don't know if you're still shareholder in Teqnion, but I know you've been in the past. So we all know more or less the kind of things they've done, and we've discussed this privately. So I definitely think Teqnion is not dead. It's true they've gone through about a year and a half or so. The macro in Sweden has been going through a tough period lately, especially affecting real estate. And Teqnion had some legacy housing businesses. There were just two of them, but they represented a big chunk of normalized past earnings, so to speak. Mm-hmm. So they've been bleeding out, and that's been a drag on Teqnion's profitability. Other companies have also had problems facing these tough macro headwinds. And I think they, with the aim of keeping the decentralized structure, I think they were a bit too far. I mean, they were too decentralized. They didn't monitor enough some of the subsidiaries. In 2020, 2021, 2022, even when things were going great, nothing happened, and everything was cool and fine. 2023, end of 2023 and 2024, when the rough times arrived, this lack of supervision showed itself. But I think they've learned from the mistakes. They've been quite transparent. They have acknowledged their mistakes. They're trying to change. We all think, at least we hope that they are, they've been like self in the Q&As, in the trading calls. Sometimes people say they talk too much, or that they are like too dramatic or too theoretical. But I think so far they've been more like they've pushed like the head down, and they've kept on pushing and trying to optimize the injured businesses, and they've accelerated the M&A. We think they've done quite a good M&A during this year. I think they've done already 9 acquisitions. Just for context, last year I think they only did 3. So they have accelerated somewhat, and that's one thing we wanted to see. The quality of these newly acquired businesses are way above the legacy business they had previous Daniel's arrival. So I think we've seen that macro will improve. Companies that now are bleeding will stop. Some other legacy businesses that are not bleeding, but operating under their potential, they can be, and they are being optimized. And all the new M&A is going to add a lot of high margin, high cash flow businesses. So overall, we just think it's a matter of time until, there's a changing point in the macro, and Teqnion can show again good organic growth, which we think they will do in this later half of the years. We think all the sentiment will change with that. I'm pretty surprised with all the money they've done, and the stock hasn't reacted. I think the market is now just focused on profitability, like pro forma profitability of the previous businesses and the organic growth. So as far as these changes, the stock will follow up, I'm pretty sure. So we think they are not dead, and they will emerge like stronger than in the past.
Yeah, I just wanted to give you some background, and maybe the listeners as well. So essentially, I don't own shares in my personal account anymore. I sold around, I think it was maybe Q1 this year, or end of Q. Yeah, I think it was Q1. I do own them for a family member, so I still think it's like a super good long-term investment. But the reason I really wanted to have this conversation is because I'm re-underwriting like the business and the valuation and all of that. So since you are an expert on this company, that's like the reason I invited you. So essentially, I'm trying not to be biased in this interview, as I don't own shares myself. And at the same time, I'm trying to figure out things for myself. So I guess I'm on the same position as many of the people watching this are. So I think that's interesting. But moving on to the next question, now that I've set the stage, I wanted to ask you on the normalized margins, because there's a lot of discussion on sort of, okay, these acquisitions are higher margin, higher quality, but at least from the press releases I've read, there isn't like an exact number, okay, this is where the margins will converge to, or anything like that. So how are you sort of thinking about that long-term or mid-term when it comes to margins? Because they've acquired essentially 20% of their 2024 revenue just this year, right?
Yeah, sure. So from 2021 until 2023, more or less, in the good old times, ETA margin, like EBIT after depreciation, but before amortization of intangibles, which is like the proxy for operating profit, was around 11-12%. Now, 2024 profitability decreased a lot, down to 8 point something percent. We think this year they will end up not as high as in the good old times, but higher than in 2024, perhaps around 9 something percent on a 2024 pro forma basis. Then the new M&A is going to add higher margin companies, higher margin revenues. So how can we know that? I mean, first of all, if the acquired business is a UK business, there's less information. You can go to the Companies Act register in the UK. They don't disclose much information except for balance sheet and some few things more. You can make some estimations of the margin, at least in terms of income or free cash flow. Although it's true, cannot be super accurate. That's for the UK business, you have to do like some rough estimations, honestly, at least until they release the quarterly results. Then you can have a precise information of what they do, of their margin profile. Then for the Swedish businesses, there's a website, it's called Alabolag, where there's free information about all the SMEs in Sweden. So you can check like the background, track record of profitability of Teqnion's acquired businesses, and you can more or less have a glance of of their profitability. Although those accounts can also be not completely accurate, but you can more or less get the sense. And then lastly, you can get like real information in their quarterly results. There's a note, I don't remember which note, but in every quarterly statement, there's a PPA, purchase price allocation note with all where you can see the acquired sales and EBITDA during the quarter on a reported basis and on a pro forma basis. And you can see what they've paid for, like upfront payment in cash, deferred payments in cash, and earnouts. So with that, you can have a sense of not the individual companies' profitability, but the aggregated profitability of the acquired companies during that quarter. And you can see the price on aggregate they've paid over that quarter. So what we've seen so far with Q1 and Q2 are operating margins or pro forma operating margins of the aggregated acquired companies around 18.5% EBITDA margin, and they've paid roughly 5-6 times upfront cash for that. So that's a good, for us, is a good ratio, a good number in terms of multiple and good margins, right? So our margins way above 2024 forma numbers. So we think overall in long term, the group's operating margins will go higher than that 11% that they had in the good old times, but when they hadn't acquired these super nice businesses. There are many other CL acquirers that have operating margins like EBITDA margins closer to 20%. So that doesn't mean necessarily Teqnion will ever reach to that stage, at least in the short term, but shows that there's margin to improve, and they can acquire very high margin businesses. So overall, we think that the group's margin will tend to improve gradually. And well, if they one day reach 20% group margins, that would be great, but it will take time, and we don't bake that into our valuation.
Yeah, that's interesting, because I obviously don't want to kind of extract all the inputs from your model or anything, but I tried to look like 1 year ahead, 1 year and a half or so. So essentially until the end of financial year 2026.
Mm-hmm.
And I have like their normalized EBIT margins, so not EBITDA, just EBIT, around 10% for the base case. And obviously then everything comes down to the multiple, because not everything, but like the difference between decent returns and outstanding returns will be, at least in the short term, will be really tied to like what multiple the market attributes to this company.
Yeah, sure.
So give us a framework to think about multiples, especially when it comes to these serial acquirers, early stage serial acquirer in Sweden. Because for someone that's used to, say, looking at nets or deep value, we penciling in like a 20 times or 25 times or even 30 times multiple is completely nuts. So just give me, what's your framework for thinking about this?
Yeah. Well, first of all, good sale acquirers or acceptable sale acquirers in efficient markets are usually given a quite high multiple. Why? Because you have a diversified stream of cash flows. If it's a roll-up, those cash flows will be correlated because that sale acquirer just attacks one vertical. No? So for example, imagine a roll-up in vet clinics, veterinary clinics, or whatever. If that sector, for whatever reason, goes into a downturn, those diversified cash flows are not diversified anymore. But with a niche serial acquirer that doesn't attack any specific vertical, but rather, yes, they operate within the industrial sector, but within the industrial sector, which is very broad, there can be different sub-niches with pretty similar business models. So it's quite easy for them to underwrite them. But, they can be different niches with different clients and demands and stuff like that. So first of all, with a serial acquirer, you have a real diversified set of cash flows. It's like a diversified portfolio, so to speak, instead of a portfolio concentrated into one factor. So yeah, one niche, one company can perform poorly during a certain period of time. Others will compensate. More or less what happened to Teqnion. They had some bleeding companies exposed to cyclical sectors. Other, pulled and compensated. And although the results haven't been good in recent times, they could have been much worse. So yeah, you have a diversified stream of cash flows, and you have that's in terms of risk avoidance, no, or and on the other hand, in terms of profitability potential, so to speak, you have like the best of two worlds. You have organic growth on one hand, and additionally, you have inorganic growth. So there are times, especially in macro recessions, where the organic growth, some companies can be negative, but the company can take advantage of that situation and do M&A at cheaper multiples due to that conjunctural macro context. So you have these two very nice, I would say, attributes that make good share acquirers very, very attractive. So big, diversified, and with a great track record share acquirers, they often boast like multiples like 30 plus times. So cash flow, you can look at Lithco, AdTech, Lagerkrantz, Constellation Software, but those have deserved the multiple due to a long period of showing consistency, profitability, earning high returns on capital and stuff like that. So on the other hand, like smaller scale acquirers are trading that's more like varied or more dispersed, the multiples you can find. But yeah, around half or even less the multiple of those super high quality shell acquirers. That's more or less what we are seeing now. So yeah, I mean, for example, Teqnion on a 2025 pro forma basis, we think they can earn around 225 million in operating profit or EBITDA. So that's an EV/EBITDA of around 14%, which doesn't scream cheap on a 2025 basis in 3 months. But if you consider future M&A, that some legacy business are literally bleeding cash, other subsidiaries have the margin for improvement, they can improve cash generation, organic growth can come back, and other things. The potential for 2026, 1 year out, is a significant boost in the operating earnings profile, more closer to 300 rather than 225. So that would make the valuation more attractive, way more.
I'm laughing because I literally have 300 for 298 in EBITDA.
Yeah.
But I wanted to clarify 2 points. So you said 13 to 14%. Is that yield or are you talking multiple?
No, multiple.
Okay, 13 to 14 multiple. And then you also mentioned like 200 and something in EBIT for 2025. So are you valuing this on a calendar year basis? So you said 3 months left, or
Yes.
are you?
My valuation of those 225 million of EBITDA of operating profit is on a 2025, so ending 1st of December of this year, 2025, on a pro forma basis, considering if all the acquired businesses during the year, they had been acquired on the 1st of January of 2020.
Okay. Yeah, so that should more or less be close to financial year 2025.
Yeah. So
interesting.
If you want some more details, so imagine like 2024 pro forma, like all the acquired businesses during 2024, let's call it legacy businesses, no? All the businesses acquired previous to 2025. I think they will have, we factor here, zero organic growth for those businesses for 2025, and the margin goes up a little bit to 9.3%. And then you have to add this pro forma new acquired sales in 2025, which is now 400 million SEK, and roughly 75 million in EBITDA. So with that, you have some 2025 pro forma numbers of around 2 billion SEK in sales and 225 million in EBITDA.
That's very comprehensive. And I think we just gave out a pretty good framework for people to think about it. Obviously, this is not financial advice, so do your own estimates and your own assumptions. But it's interesting to note we are kind of close, even though we hadn't talked before.
And yes, and this is, I repeat, just on a pro forma basis for this year. So it's almost like trailing numbers, you know?
Yeah, exactly. I didn't do much kind of a castle of assumptions in there as
Yeah.
well. So it
Also,
was just
you were think asking me about like my valuation multiples that
yeah.
these kind of businesses should receive. I mean, of course, Teqnion shouldn't receive a 35 times multiple on free cash flow yet, or because I mean it's smaller than Actec, is smaller than Lifco, doesn't have the track record. What we think is that the probability of the multiple to compress from here is quite low. At least on a base case scenario, you can get the earnings growth. Perhaps, yeah, if they keep on executing. I mean, Teqnion traded at 30 or 30 plus times earnings in 2021 or 2022. Perhaps it was a little bit hype at that moment. I don't know. But it reached that valuation. Perhaps it will never reach that valuation again in the short term, but I don't know, 20 times earnings, 20 lowish times earnings. That would be an optimistic scenario for us where you will have some multiple expansion there. But we don't need that to get a decent double digit.
Yes, for sure. I mean, it's just doing the math kind of if you pencil in like the normalized margins and essentially we are still getting effects from the negative cycle of the construction businesses. So, let's say normalized, it should be at least higher than we are now, and peak cycle should be even higher, and that effect should kind of um wipe away once they acquire more and more businesses. So
Yeah, exactly.
yeah, I think that's extremely interesting. I also wanted to kind of talk about um management, because essentially now I'm basically an outsider to this company. I'm not like a shareholder, so I've just been curious to kind of observe the behavior and sentiment of people and how quickly it shifts as well. So why did people lose so much confidence in the management, where before they thought like they were like super high quality and 100 bagger management, whatever they call it, and now it's more like this, like there are even accounts just posting bad things about them and trying to kind of push the management down. So how do you think about management, and how do you still trust them after all of this like bad news, sequential bad news over time?
Yeah, yeah, good question. I think, well, people or the market in this case were always, we act like a pendulum, and the pendulum can either be on one of the sides. You either love them at one moment, and suddenly you hate them. I think the truth perhaps it's in the middle. I mean, they're a good management team. Perhaps like in the past couple of years ago. I mean, their financials were like firing on all cylinders. And if you add that together with, these guys are kind of outsider CEOs, like extravagant, if I may, or, they sometimes in their conference calls, they mention like Warren Buffett or some, value investors, key concepts and stuff like that. So that perhaps made them look like, the next Mark Leonard or something like that. And perhaps that attracted a lot of hype as well. That's why perhaps it got a little bit ahead of itself in terms of valuation. But I genuinely believe that these guys are good people. They are not a fraud, because now many people say that Teqnion's management team is a fraud. They're useless. They've made mistakes, but I think no. We've seen that they've taken action. They are improving things. The M&A, which is like the pillar of the thesis, is going on the right direction with the data we have, the data we talked about before. It's true that I would prefer them to speak less, or stop saying those kind of keywords and stuff like that. But it's in their DNA. I don't think they will stop doing that as long as they keep on improving the company, and so far they've been doing that. I'm okay. I trust them. They are incentivized, and I still have confidence on them.
Yeah, I think that's very good. As a follow up, do you think their communication mistakes and operational mistakes were more due to ignorance or malice?
Oh, of course, ignorance. Of course, yeah. I mean, in terms of communication, ignorance. Although there you cannot be completely sure. I mean, you have to believe them. You cannot prove that all the missteps they did were only due to ignorance. But I believe so. I would ascribe a low probability for that to be like malice. And then on the operational side, also like lack of experience or ignorance, if you want to call it like that. We talked about it previously. Like I think they didn't oversee the subsidiaries as they should in the past, but they've taken steps. They've improved processes in terms of reporting. New regional managers. Now they are gonna keep the decentralized structure, corporate structure, but they will monitor more closely the subsidiaries. The subsidiaries MDs now are highly encouraged to raise their hand as soon as they see any kind of problem. But yeah, I mean, operationally, that's for sure it was a lack of experience or, these kind of things that can happen when it's a young company. And on the miscommunications, I also believe it's ignorance, although you can also attach a small probability for that to be malice, no? Or they did it on purpose, but I don't think so.
Yeah, I think that's a fair assessment. And I mean, it's also really hard to believe they did it with malice when basically their whole financial stability is tied to the company, right?
Yeah.
So they are either extremely irrational, which they don't seem to be, or yeah, it was like just inexperience and mistakes they are learning from, I guess, in some way. I wanted to talk about the incentives because essentially Daniel borrowed, I don't know how many millions, but yeah, it's a sizable amount, definitely, and especially for him. So how do you think about the pressure that puts on him to acquire? And yeah, isn't that a risk that essentially Daniel owes Johan money? And so if anything happens to either one of them, hopefully nothing will happen, but if anything happens, that might be a risk for the thesis.
Yeah, I mean, those incentives, keep them aligned, of course. But yeah, it's true that could be a double-edged sword. I believe you are telling me this because of, perhaps now Daniel is eager to seek for more risk, or do more M&A, accelerate the M&A pace, and perhaps he can do bad acquisitions or overpay or things like that, right?
Yes.
Yeah. So, yeah, could be a risk to monitor. But again, the only way to monitor that is through their acts, the facts, the data. And so far looks good. But yeah, it's something to monitor. Yeah. Next Q3 earnings release, I will go directly to the notes, PPA note, check what the real margins, acquired margins in this quarter have been and how much they've paid. That's something to keep an eye on. Could be a risk, but also I think it's more incentivized on the wood way rather than on a excessive risk-taking way. But of course, you have to monitor that. And if we see that they're starting to overpay or acquiring like what we think are bad businesses, that would be a red flag. Yeah.
Got it. Yeah, that's perfect. And what sort of other metrics should investors track in the mid to short term to kind of assess where they stand in the turnaround process? Because I guess what a lot of people are waiting for is, okay, when will they show the first signs that things are turning so I can getting it at the exact right time and not take the risk of like catching a falling knife, but at the same time capturing the upside, right?
Well, they've mentioned in their last earnings call, I think that H2, half two should be the inflection point. So we would expect some kind of improvements in organic terms, margin and organic growth in Q3, and we would like to see a further improvement in Q4. So if you ask me if I had to bet, I think the worst was it's already in the rear view mirror.
Okay.
But yeah, that's another thing to monitor, just to keep track of what they say versus what happens with the business. They've mentioned that half two should be an inflection point. Let's see if that's really an inflection point. So based on their guidance or what they've said, now we should start to see an improvement. What are the metrics to focus now? M&A is going on well. So as I said, organic growth and legacy subsidiaries improvement in profitability. Those are and cash flow generation, because it's been quite weak in recent quarters. So cash flow generation is also an important metric I would follow close.
Correct me if I'm wrong, but I have a theory, so I will tell it to you and maybe you can give me some feedback. I think that usually when things are not going that well, management tends to avoid like public appearances or interviews or just talking to the public. And usually when they start going back again on podcasts or like doing interviews and all of these things, it might be an early sign of things are turning. Now, I'm not saying this is the case for Teqnion, but Johan did do an interview with In Practice. And so that makes me wonder whether, yeah, now we are more of like past the bad times, or we still have more to go. But I think that would be a reasonable kind of assumption.
Yeah,
I don't know.
actually, I hadn't thought about it, but it's true that Johan did an interview in practice a couple of months ago, if I recall properly. And yeah, during this last 1 year and a half, where the operating performance of the company hadn't been great, it's true that they hadn't appeared much on podcasts. And before, during the good old times, they appeared a lot, right?
Yeah.
So I hadn't thought about it, but it could be an indicator for sure.
Yeah. Alternative indicators right there.
Alternative data. Yeah.
Yeah. Actually, I think I remember the exact day the interview came out. I think it's like 29th of August. So yeah, I just remember because I was in vacation with my parents. I know this is a
Me too.
crazy
I was
tangent,
really
but
on the beach.
okay, nice. And okay, now I wanted to kind of transition to your own personal philosophy. How has it changed? And what lessons did you learn from owning companies like Teqnion? Maybe, yeah, you can just give us an overview of your philosophy. How has it changed? And what have you learned from Teqnion?
Well, our philosophy is pretty straightforward. I mean, we tend to invest in small caps, mid caps,
Yes.
with a kind of GARP quality approach. In the past, we did some mistakes buying some kind of not yet profitable companies that we thought they would become profitable quite fast, and it didn't turn out that way. So now we try to avoid unprofitable businesses. We can make a few exceptions, and we see it now very clear, but we now reduce the amount of these investments. What we focus on is especially in incremental returns on capital, and that it's driven by basically by improvements in margins. Also growth. We value a lot good inorganic growth. That's why we have a big part of the portfolio allocated to serial acquirers. I think roughly like 2/3 of the portfolio is invested in this corporate strategy for growth. And the other third could be small caps, what we think are well managed, cheap, and with a decent growth small caps. What we've learned from Teqnion, well, when there was this maximum hype, it was trading at 30 times in 2021. In hindsight, we didn't sell enough, of course. We could have sold more. I think although we entered in Teqnion quite early, I think it was before it was very well known. I think that we let us, we were, I don't know how to say it, but yeah. We thought that things were beautiful and we extrapolated too much, and we thought that they will continue to do these kind of things for the foreseeable future, and that at 30 times we could have a decent part of the portfolio allocated to Teqnion, and it didn't turn out that way. So what we have learned from this is like with small serial acquirers with not a very long track record, if the valuation reaches to the high levels, I mean, 25, 30 times earnings, then you should, I don't say selling all the stake, but like reduce it.
Yes.
Substantially. We just reduce a little bit, but not enough. And also, we've learned that, I mean, the management is good, but, they were considered, and we consider them as, like something like gods.
Yeah.
And I think they can end up being a very good management team, but they will need to prove it, and it will take time. I think they have all the attributes and skills to be like very exceptional, outsiders CEOs, but they still have to learn, to make a little bit more mistakes, improve, and they are not yet there, but they will. I believe they will be.
It's very interesting that you mentioned like I should have sold more or trimmed more, because I think that's a common theme among investors I've interviewed and talked recently. And it's a lesson I'm really thinking about, because mostly you regret of not, like on average, you regret more not selling enough than like not holding or like not buying more, I think. At least that's my experience. You can correct me if I'm wrong, but by definition, these 100-bagger opportunities or multi-bagger opportunities are extremely rare. It's more common to have, let's say, doubles, triples, or things like that. So after those companies turn out to be multi-baggers, it's very likely, or it's very hard, I mean, to keep that trajectory, and very few businesses kind of graduate that stage. So I'm also trying to learn to trim more when things are going very, very well and they're likely to turn, or at least it's very hard to imagine that they will improve further, and then like add back again when things are pessimistic. Because yeah, it's not black or white. It's not like selling everything or
Exactly.
buying everything, right?
Exactly. I'm of the opinion that you should let your winners run and deserve their position in the portfolio. And
Yes.
with Teqnion, that happened in the past. We bought around a 5% stake in the fund. By the way, our fund is a UCITS fund, so by legislation, we cannot concentrate more than 10%
Okay.
of the assets under management in one position. So our largest position can just be 10%. So with Teqnion, we allocated around 5-6% at the beginning, and it grew more or less. I think we bought a little bit on the way up. So it reached like 10%. And in the good old times when there was all this hype, I think we sold a little bit back to 6-7% of the portfolio. Went down recently in the last year and a half. And we didn't do anything at first glance because, there were all these issues with miscommunication, stuff like that. But now what we've seen that the M&A engine is back on track, that the organic or legacy operating profitability is giving signs of improvement, organic growth is supposed to be back sooner than later. And that in the end, after reflecting about the management, we still believe in them, we still think they are good, we still think they are honest. We've added back, and now it's again at 9% of our portfolio. So it's our largest holding now by difference, by far. And yeah, we've been back in all these weaknesses during these past months. We have to keep an eye on these things. There's going to be an improvement sooner than later, that the M&A is being done at nice multiples, that they acquire high margin businesses, that the cash flow conversion comes back. So if those things that we are going to monitor closely don't happen, I mean, we will reduce substantially, of course.
Yeah. I'm just curious about the 10% limit. Do you have to sell every time something becomes larger than 10%, or you can't allocate more than 10% at cost?
Okay. So I'm going to tell you like all the regulation. I mean,
Okay.
no, it's fast. It's quite simple. So you cannot allocate more than 10% in one position.
Okay.
And your 5 largest positions cannot altogether weight more than 40%. Okay, so that's but regarding the 10% restriction, it's at cost. So if you buy exactly 10%, you can do it. The share price appreciates above that 10% threshold. You have by law 6 months to reduce it back to 2%.
Wow.
So you can keep it 6 months above that 10%. So it's at cost.
And do you feel like that has played a disadvantage or an advantage for you over time?
Well, we wish Pedro and me, we would have a little bit more concentrated portfolio. We would never have a hedge fund with like 5 or 8 positions, but I think our sweet spot would be more around 15 names, 20 names maximum. Now we have to have like 25, 30, which, I mean, those businesses that we are like, tracky positions, or that we think they are high reward but high risk, we tend to allocate 1% or even less of the portfolio, just to, comply with the regulation. But if we could, we would have a little less concentrated portfolio, I would say. I think it's a restriction that works against the fund managers, I would say. It's true that it's also protected a lot of LPs or investors in the funds from big disgraces. I mean, there have been blow-ups, and several investment managers in Europe, they had one big position which collapsed. And thanks to that restriction, the fund didn't collapse entirely. So I think it has prevented major disgraces. But in our opinion, we would do better if we could have a slightly more concentrated portfolio.
Yeah, and then I'm thinking here, essentially, let's say you have allocated the full 10% at cost, and then the position goes down a lot and you want to buy the dip or like buy it average down essentially, then you can't do it, right?
Yeah, you can.
But if you already have 10% at cost,
I know, but imagine we have Teqnion at 10% at cost, and tomorrow the share price goes down 50%. Considering the rest of the portfolio, that's nothing. Teqnion weight in the portfolio would come down considerably, around 5-6%.
yeah, but at cost it would still be.
No, but it's always okay. But at cost was not the word. I mean, I would if that happened, if Teqnion share price would decrease 50%,
Okay.
and its weight in the portfolio would go down for 5 or 6%, I could add up to 10.
Okay.
It's just
Okay.
when the share appreciation causes to surpass that 10% threshold, you have 6 months to sell down back to below 10%.
Okay. I think that's clear now, and I won't ask you more on regulations.
No, it's good so people can know about the usage regulation, because the vast majority of the retail funds, like what in the USA would be mutual funds, have this kind of regulation in Europe.
Yeah, it's kind of hard for people that live outside of Europe to comprehend, because I always see like things are much easier in the US when it comes to like financial and like Ks and all these programs that allow you to have tax-free investment and all that. Yeah, I think that's interesting. And how do you manage risk, and how do you think about risk in general? Do you manage it by position sizing or by doing more research? And just give us your framework.
Yeah, I mean, basically by position sizing, and also, I mean, we analyze individual risks of the companies, and we try to assign some sort of probability of that happening in the next 2-3 years, and the potential impact that could cause in the company. And if we see many risks, or some risk with a lot of probability of happening, or some risk with a high impact if they could happen, that company should tend to have a lower weight in the portfolio. It will still be in the portfolio if we think the risk-reward ratio is very compelling, right? And we still think that the probability of those tail risks. Also, yes, the more we get comfortable with a company, that means knowing the business model or the management team, we can allocate a little bit more to the portfolio. That kind of, for us, this decreases the risks of corporate governance or bad management, which is a risk. So that enables us to increase our stake if the management team has a good track record, if we've been able to check what they've said in the past compared to what they've done, things like that. If they've shown a good capital allocation skills. So that's enables us to increase a little bit the weight in the portfolio. And then the portfolio is built in bottom up, but then we do some sort of portfolio management. So it's on an ex post basis. So it's just to adjust or fine tuning a little bit the portfolio. Then we take all the holdings and we say, okay, which kind of aggregate risks are we exposed, or factors? Factors is one thing, like small caps or sectors or countries or whatever. And then aggregate risk, like tariff impact risk, or I don't know, supply chain logistic disruption risk, or inflation risk, or some kind of risks that can affect more than one company in the portfolio. If we are too exposed to any of those, we can trim a little bit those holdings to get to the exposure or the risk we desire. But that's just fine tuning, because we never end up with a very factor or risk concentrated portfolio or sector concentrated portfolio. We are quite diversified. We review it. We review it like every 1 or 2 weeks, how it's everything going on. But it has never led us to make major changes doing this, let's so call it, top-down portfolio review. But we do it, just in case.
So now that we have a general overview of how you think about investing and how you approach risk, can you talk about your highest conviction idea and maybe how that encapsulates your whole philosophy.
Well, Teqnion could be one, but we've talked too much about
Yeah.
Teqnion. So yeah, our next highest conviction idea. It's another Swedish serial acquirer. It's called Berner Industri. It operates in a similar way than Teqnion. I mean, it acquires niche industrial businesses.
Yes.
The background is a little bit different because Berner was born more than 100 years ago as a tech trading company. That meant that they didn't produce the products or the goods or the technology. They just imported it from outside Sweden, and they were, let's call it, value-add resellers. They bought from manufacturers or OEMs, and they resell it to clients. And that's nowadays their legacy business, which is called Christian Berner Tech Trade. But they have another division, which is called Energy and Environment, where they've been doing M&A. And those acquired businesses tend to have like manufacturers of their own products. So they own their brands, they own the IP.
Yes.
They are producers, although they can outsource the production, but they own the IP of what they produce. They own the brand. So those businesses tend to earn higher margins. And that kind of businesses that Berner acquires in this division are more similar to the businesses Teqnion is acquiring nowadays. So that's more or less Berner. It's smaller in size than Teqnion, or at least in terms of subsidiaries. Teqnion already has 30, 20, 20-ish, 30s. No? Berner has 9 subsidiaries. It went through a period of organic growth. I mean, Berner Industri is never, I mean, it became a serial acquirer after 2018 when they decided to start the M&A engine. After they joined the main market in Stockholm, they had some cash to do some M&A, and they started to acquire companies. I don't know. I have a presentation of Berner. If you want, I can
Yeah,
share.
you can just share your screen if you want.
Yeah, it's in Spanish. Sorry for that, but I will
see what you have.
translate. So yeah, Berner, as I said, was founded more than 100 years ago as a trading company by Christian Berner. Now the Berner family owns a good chunk of the company. It was listed in 2014 and then went into the main market in 2017, and that's when they started to do some serious M&A. Their subsidiaries, they have a strong competitive position in a wide variety of industrial niches exposed to secular tailwinds such as electrification, urbanization, infrastructure, water treatment. Okay, so this is when 2018 they started to do some M&A with Thunder and Industri, Wheeler Beckham Parent, Empac, Swedenborg, and now Autofreak. Before they didn't do M&A. These are the two divisions we talk about. Technology distribution is the legacy. Value-add resellers, they don't own the products, lower margins, 5-6%, although peers can show 10-11%. And energy and environment, where they own the IP and are these subsidiaries that we've seen in the chart before. They do, Autofreak does water treatment, Swedenborg does some air funneling, Wheeler Beckham Parent, some vibration and sound isolation products, and Thunder and Ingerstrom, they do some what is called set boilers, are like electric water boilers, some steam boilers that they use the excess electricity created by the nuclear mix they have in Sweden to heat water and create steam for various industrial processes. And also they have some water pumps business, residual water pumps. So basically the investment opportunity comes in 2022. The previous CEO had a too centralized corporate culture, and they focused a lot on too much on M&A. So the legacy business started to perform poorly, and the Berner family brought Caroline Reuterskill, who comes from Lagercrantz, which is one of the most renowned serial acquirers. Actually, she was the MD of the most successful division of Lagercrantz called Niche Products. And yes, since her arrival, she has been reorganizing the corporate structure, restructuring, cost reduction, process optimization, and creating a decentralized corporate structure. So she has been cleaning the house for the last 3-4 years. He has not done any M&A until May or April this year when they acquired Autofreak. So now we are starting to see the fruits of the optimization, and also we can see that the M&A engine is starting to get back, all with a stellar CEO, right?
Yes.
I don't know what more to add because it's a quite long presentation. So if you want, you can ask me specific questions about Berner. I just wanted to make an introduction on why the investment opportunity is attractive. This is one very insightful slide. So the red line marks Caroline's arrival. This is cash flow generation. This is cash flow generation. So the blue bars are cash flow in Swedish crown million. And the orange line is cash flow conversion. It's cash flow as percentage of operating profit. So you can see a structural and substantial improvement in the company. It was bleeding cash, and now it's a cash machine, right?
Is it cyclical?
It's cyclical, yes. I mean, energy and environment is less cyclical because there's a lot of water treatment, a lot of infrastructure clients, public administration clients. But the legacy business, technology and distribution business, is more cyclical. And also they had a very rough time in 2021, 2022, when the rest of the macro was doing well in the Nordics. Since they were value-add resellers and all the supply chain was very constrained, they had a rough time. Not because there was not demand at the other side, but because they couldn't get supplies.
Yeah.
So it's a little bit cyclical, not too cyclical. They have exposure to real estate, such as Teqnion, but they had a rough time in this 2022 moment of supply chain disruptions. But in the end, it's like Teqnion. As time goes by and they do more M&A, they will be more diversified, right? Well, yes, this is the insiders, which is the Berner family owns 60% of the voting rights because there's some Class A shares. You have some other funds which share like similar philosophy to us. This is, by the way, Sun Mountain Partners is the fund of William Thorndike, is the author of The Outsiders. He has an investment fund and he has invested recently in Berner. And this is kind of our expectations. What we were talking previously about Teqnion is 2025 pro forma basis. We've done the same for Berner. So yeah, kind of trading at 15 times operating profit or 16, 17 times free cash flow. Autofreak acquisition has 15% operating margins. I think the CEO, will continue to acquire high quality business. Overall, the group operating margin will tend, like Teqnion, to increase over time. Here you can see the difference between technology and distribution operating margins. The 5-6%, 2024 was a complete disaster. Yes. Now they are reverting back. Whereas energy and environment, there's been a substantial improvement. Autofreak goes into this division, by the way. So you have two worlds, right? One legacy business, which is good, but not super great. However, they earn good returns on capital. Although they have low operating margins, their capital employed turnover. So the sales divided by the capital employed is very high because they have a lot of inventory rotation. So it's like a retailer, they have thin margins, but you can fight retailers with very high returns on capital. I don't know, Dino Polska, for example. So this is more or less like the kind of, profile the legacy business has. But we believe the M&A will continue in energy and environment. So as you can see, the valuation is similar to Teqnion, but there's this important thing, So this is Berman and Beving, which it was a big conglomerate serial acquirer in Sweden. It still is, but they've done a lot of spin-offs. Attec Tech, Lagerkrantz, they are all spin-offs of Berman and Beving, Momentum Group, AdLife. So now the remaining Berman and Beving, many of the companies of the remaining Berman and Beving were also value-added distributors, and they were having some trouble back in 2019, 2020, and something similar to Berner happened. Magnus Söderling, who was manager at I don't remember if it was at Lagerkrantz or AdTech, but he came back to the mother company, to Berman and Beving, to fix things. And when he came, Berman and Beving was showing 4% operating margins, and now they are almost reaching 10%, with the aim of surpassing that next year. I show this slide to show that these 5-6% margins in the technology and distribution, if you bring a good manager which is incentivized and brings the Lagerkrantz playbook, margins in this division could go up substantially, right? And if you add that good M&A growth and organic growth in this division, you can get good returns without multiple expansion for Berner.
What are the incentives for the CEO? What are they based on?
Yeah. So she didn't earn any cash bonus last year, and she has a warrant program, stock options program. So when they grant the stock options, that's the market price of the stock is the strike price, and the vesting period is 3 years.
Based on what?
No, it's just stock options. It's not restricted stock units or something like that based on operating performance.
Okay.
It's just, I give you some options, call options on our stock, and the strike price is today's market price, but you can only exercise that after 3 years.
Okay.
So basically what she's incentivized is to keep the share price higher than
Last 3 years.
Than when she got those stock options granted. Yeah, we would prefer to see perhaps some stock performance, stock units based on return on capital, cash flow, but still is not bad. And the family, the Berner family, is in the board of directors. Actually, the older Berner is the chairman, so he's gonna make sure this woman is incentivized and that she does things properly. She has done some stock market purchases, although small in amount. It would be great to see her buying more stock. That would be a very good sign for us. Now she owns roughly 0.4% of the company. She has arrived not too long ago, so it's normal that she doesn't have a big amount of stock in Berner, but we would like to see this to increase, right? And not only by stock options. But on the other hand, you have a family that controls the company, and will watch that she does the proper things. And also, she has a very good track record. As I mentioned, she was the MD of niche products at Lagerkrantz. She did a very good job. Niche products division at Lagerkrantz, by the way, the whole division on aggregate has above 20% operating margins. So
Nice.
we have, she has a very good track record, and she's incentivized, and we've talked to her. She's excited about this opportunity. But things to monitor, that she buys more stock. That would be something to keep an eye on. That would be great to see that. And that's more or less the story of Berner and the opportunity. I don't know if you have any more questions.
No, I think that was perfect. I think we can ask the audience to comment down below if they have any questions, and maybe I invite you to answer them or ask them and then give them the answer. I think that would be a pretty interactive way to approach it. I think, obviously I mean, it's not obvious, but I had studied Berner before. in my serial acquirer journey. So it's interesting that they have implemented some change. I honestly haven't looked at them for a long time. So
Yeah.
very, very interesting case, and I appreciate the presentation as well.
Yeah, no
Maybe
problem.
I'll just ask one more question to wrap up, and then we can do a part 3 episode in one more year. I think it would be cool to kind of sit down and look back at the episodes that we have done in the past to see where
Yeah,
we were extremely dumb or
yeah.
made mistakes.
We'll see how Teqnion and Berner play out in the
Exactly.
next year or next year. And
Yes, perfect. So last question is, what advice would you give to the next generation of investors?
tough question. I would say be flexible. I mean, don't attach yourself to any kind of, morning star box of value, deep value, growth. You have to be flexible. Here's the risk that you change opinion or you are too flexible and you end up,
Yes.
having no concrete or specific philosophy. But you know what I mean? Like try to find your own philosophy and the philosophy that adapts to your personality, because there are many ways to do well in the stock market,
Yes.
but not every philosophy matches each personality. So that would be my biggest advice. Start
Perfect.
with what you've first learned, evolve, be flexible, and try to find the things that match your personality. Because if you are, I don't know, like a calm investor and with a long-term focus, if you go like to buy nets or flipping around cigar butts, perhaps it's not the best match for your personality, I would say. Each person has to adapt their style to their personality.
Isn't it crazy that 80% of you aren't subscribed? So, if you made it this far, here's my promise. Follow or subscribe for free, and my team and I will make every episode 1% better. Check out the last episode too if you enjoyed this one, and thank you so much for listening.